to the first panel for the day. Mark Thurston is going to join us, and he's going to introduce the panelists. Most of us who have trafficked in equity strategies know Mark from 24 years at Russell, where he really changed the nature of the way Russell looked at equity managers. We found him engaging, we found him intelligent, and so much so that he left the organization and started his own firm called Alpha Signal. And so, Mark, why don't you bring your, where are you? There you are. Why don't you bring your team up and get on with our first panel.
So the first thing I want to do is just thank Magda and the FRA organization for allowing us to do these two panels. My history, as Bob mentioned, is in manager research, and I worked at Russell Investments, which has a rich heritage in investment manager research. They started doing it in 1969, and it's kind of a great story. George Russell joined his grandfather in 1956, and from 1956 to 1969, they essentially did his grandfather's business, which is selling and distributing mutual fund starters. He was like a broker. But after he joined in 56, he joined his grandfather and a support person, an administrative assistant. His grandfather died within like the next 6 months. So George was very adamant about calling it the Frank Russell Company after his grandfather, but most of us think of it as the George Russell Company. In 1969, he went to JCPenney and he said, hey, we think your bank is underserving you in picking your managers because what they recommend is one organization to do everything. And we know that specialization is a benefit. We think we can pick managers from Bank A that are good at fixed income and Bank B that are good at equity. And we think you should pay us to do that and your results will be better. So that's the gist of the business. He got really lucky in 1973 with ERISA, because ERISA said if you're doing pension plan management, you have to do it better than you've done it in the past, and you have to hire an expert. Well, George had done this in 1969. He was really the only expert. So his company picked up AT&T, General Motors, IBM, all of the biggest pension asset owners in the US at the time. He limited his business to 40 firms, and he was able to fund a very rich manager research organization. We have two sessions today, one on qualitative manager research, one on quantitative manager research. I've always been very proud of Russell Heritage and thought that they did it great, and they did it fantastic in the 70s and 80s and 90s. The reality is Russell is more of an asset manager now. They still have a big consulting business with a couple $1 trillion in assets under advisement, but the staffing at Russell versus like Bank of America is just very, very small relative to the asset base. So anyway, there's a lot of new entrants in the manager research function, and we have to recognize that there's great techniques that we've learned from the past, but there's also great techniques to be employed going forward and currently. So the first thing I wanted to do was introduce our panelists and let them talk for a couple minutes about their organization and their role, so you understand it well if you're going to interact with them or the folks at their organization. So maybe Jordan, you could talk a little bit about your organization.
Sure. Good morning, everybody. Great to see everybody here. So I'm Jordan Rubel. I'm the head of manager research for Brown Advisory. Brown Advisory is an investment firm with about $75 billion under management, the majority of which is a private client business. We advise families, family offices, endowments, foundations. We also do have an asset management business. I joined the firm about 7 years ago. Prior to that, my career had been a lot of direct investing experience. I've been at the family office, at a few different hedge funds, as an analyst, as a portfolio manager. So we take that sort of investment orientation into our process, which we'll get into in a little bit.
I'm Adam Jordan, and I'm Director of Investments at Paul Reed Financial Group. We're a wealth manager based out of the Seattle area. My role is fund selection and portfolio design. Our firm's primary focus is the individual investor, that's retirees, mainly the middle market, mass affluent. So My role, I've been there since 2002, and my role kind of took over the investment side of that in 2007 or so. So we got the good times of 2008, and kind of started from there. But again, we are the end user of your sub-advised funds, essentially. So mainly using mutual funds and ETFs.
Good morning, everyone. So nice to see everyone this morning. So my name is Maria Ma, and I'm with Lincoln Financial Group. My company is based in Radnor, Pennsylvania, about half an hour away from the city. I've been with the firm for about 4 years. Before that, I spent about 10 years at SEI. So currently, I cover fixed income and international equity. Lincoln is a pretty big insurance company. We have 180 billion assets under management. About 80 billion is Lincoln proprietary for the VA mutual funds. We have about 92 funds. We majority long only fixed income, equity, multi-asset strategies.
Thanks, guys. So a little bit about logistics. We're going to try to make sure we have 10 minutes at the end. So for Q&A, and hopefully we'll get some good questions. What I wanted to do is just introduce the topic and show a couple of slides that I've worked on over the years that kind of are big picture and kind of illustrate the qualitative side of manager research. So I'll start with that, and then we'll go to questions. We'll have each person describe a little bit about their process, so you kind of get a flavor for the differences and kind of understand how their organization works, which I think will be helpful. But let me start with some introductory slides. The first thing I was going to say is I partnered with Citigroup and wrote some articles for them. They're limited to 800 words, so I tried to make them fairly punchy. And I just wanted to touch on some of these topics. They're all within my domain, which is a relatively narrow domain compared to everybody in this room, and that's just manager selection. So the first article just talks about capital markets. And if manager research folks knew a ton about capital markets, they could say almost immediately if the strategy is going to do well. And most people think they know a lot about capital markets, but they probably know less than the managers across the table, because the managers are in them all the time. So that's the first one I chose to write, and I think it's hugely important because I've always thought, well, I'm a great manager research person, but if I knew capital markets, I'd be a hedge fund trader and I'd be a billionaire. So I don't know capital markets that well. So that's always a challenge, and it's a challenge to know what's happened historically, and then it's a huge challenge to be on top of what's happening on a day-to-day basis. It just takes a ton of effort to figure out what's going to happen with oil now, or when is value coming back. So capital markets are the foundation of this entire industry. The next one, I wrote an article, and CityWire didn't work with me on editing it, and it's really the importance of dispassion. So we have to be very passionate and work really hard, but we have to introduce dispassion to keep some guardrails on and keep some controls on. So that's that article. Probably the biggest revolution in the past 20 years is this understanding of behavioral bias and how it impacts us. I'll talk about that in a minute. And then I'll talk about this in a minute too. How do you structure a team ideally if you're going to do manager research? And it's really the notion of if you have a lot of scale, how might you structure it? And then if you have less and less, what should you do to try to do as well as the guys that have a lot of resources? Talk about that. There's an article on credentials. CFA is a great credential because it's hard to get. So if you get it, you've studied hard and you've done well because it's hard to pass the test. Other credentials are less valuable, so it's just that point of credentials aren't credibility. You have to go further to establish credibility. And then the last part, I was going to mention that I'm going to put together a conference. I'm not. My company Alpha Signal, my partners are going to put together a conference in the first quarter. It'll just be manager research and then a few sessions around manager research. And what we'll get into is just think of exploding these two sessions, the qualitative session and the quantitative session, into a day and a half. And then adding a few other sessions on. For sub-advisors, for managers, how do they need to understand how the ideal manager research process works, and then how can they work efficiently with that? And so I mentioned that first, and then I'll just go through these slides relatively quickly to give these guys a chance to speak. But I don't know how to put this in slideshow mode. So can anybody help me out here on how to do this in the slideshow? Is it? Oh, okay, there we go, sorry. So this is a slide that I think is helpful, but it's mainly because I put it together so I understand exactly what it's trying to say. So the fewer decisions you have responsibility for, the bigger the impact on ultimately the beneficiaries of the assets. So asset markets, there's tons of decisions that behavioral bias impact. Like, you know, a brand may be super compelling, and that may allow that company to sell products that don't really cost anything, but you put a brand on it, they make a ton of money. To me, that's kind of a behavioral issue. Like, why should this product that's not very good command all this money just because it has a brand on it? It's like a behavioral bias. Warren Buffett has done well with these kinds of things. Amex charges more than Visa, primarily because of the brand. I don't understand it, but anyway, that's asset markets. You understand there's tons of things happening in asset markets. If you know behavioral bias, you can see that all these little impacts. The asset manager has the opportunity to profit from the goods markets, but those are fewer decisions because there's not as many factors you can capitalize on. The advisors, the consultants on the institutional side, and the advisors to the high net worth folks, they have fewer decisions to make, so each decision they have an impact on is going to have a bigger dollar value per decision. And the kings are the asset owners because they're controlling trillions of dollars. And they control higher fire decisions, and if they make those decisions wrong, the impact on the beneficiary is just massive. And they only make a few decisions. So the point here is we have to be very aware of behavioral bias and the opportunities it provides for managers to profit from, and the challenges that they face by falling prey to their own behavioral biases. If you think about the hierarchy and the asset owner being on the top, they just make a few decisions. And if they get those wrong, there's huge financial consequences. So simple point, remember the importance of the behavioral bias on the entire investing food chain, and it impacts the asset owners the biggest. So I mentioned there's an article on structuring teams. You can read that article, it'll basically contain the gist of this. But the notion is, if you consider a couple of things, your resources, how much money can you spend? Well, that's how many analysts you can hire. That's how much analytics you can give them. That's how much data and cleaning of the data you can give your analytical systems. So the notion is, what might be best? I have a little circle here that says, here's the sweet spot. I'd argue that if you give authority to the most senior people in the organization, it's usually the case that they're a little farther away from the details, and they will make decisions that are less ideal because they're not in the trenches. So the notion is, if you're on the top of this axis, you're giving the decision-making authority to the most senior people. That can actually be counterproductive. We all understand if you give authority to people that have just been there a short period of time, that's very likely to be counterproductive because they don't have the perspective that you get with experience, training, etc. So anyway, that's the notion of, if you just have a few people, it probably makes sense to have them be generalists and do the best they can. The ideal situation is if you have a combination of a bunch of specialists that can go deep, and then you have people that are very experienced that act as a checkpoint on top of those people, and also a process that's very refined and defined, so that acts as a check on their decision making. And again, there's 800 words on that as well. This is really, to me, there's a lot of things on this chart. I think I can explain it pretty simply. The goal of manager research from a purist perspective is to come up with a forecast of how well the manager is going to do in the future, or that investment product is going to do in the future. So it's essential to realize your rating, in most cases, some firms don't do it exactly this way, but in most cases, your rating is essentially a mapping to a forecast of future, and it's really important to say excess return. If I had it to do over, I'd probably call my system, or my company, excess return signal, because alpha is only relevant to the client. The client defines their risk tolerance. The client defines their utility. We all make the mistake of saying, well, my product had this alpha. Well, what is alpha in the context of that product? Yeah, it's a measure of risk and return, but the client has to define their risk and return and their utility. So you're coming up with a forecast, and it's really a forecast of excess return. Because when the asset owner puts that product in with all the other products, that's the only time the alpha decision really becomes relevant. Otherwise, you start micromanaging your emerging market small cap slice and say, well, I really need alpha here. You don't need alpha, you just need a contribution to the fund's alpha. So, I'm pretty adamant about that because we all make the mistake. And we always talked about alpha at Russell when we meant excess return. Russell's a multi-manager, portfolio manager, and asset manager. So what matters is the ultimate deliverable to the client. If the client hires Russell's to do a globally diversified, all asset model, then the alpha of emerging markets even is not relevant. It's just not relevant because the client wants excess return from emerging markets. They want a risk and return experience from the entire fund. So anyway, to get there to the forecast for a product, you want to have a very systematic process and you want to be methodical how you go through that. That's the left hand of the exhibit here. I've only written one article for CityWire that's published, and that's really how do you prepare for this process. What I intended to do was write one on how do you actually do the interview process, how do you meet with managers, and what do you focus on there. One on analysis, how do you come to the meeting with hypotheses that make sense, and then how do you generate new hypotheses, and then how do you test them. That's a big piece of this. And then ultimately, I think of the forecast as a synthesis of everything you learned. And the synthesis is most simply understood as how do you weigh all of the elements? Because in some cases, things that matter greatly are irrelevant to another case. So really the essence of coming up with a good forecast is saying what matters. The second panel we have here is quantitative techniques. One of the key pieces of it is how do you evaluate quantitative managers? Well, evaluating quantitative managers is very different from a manager that hardly uses any quant at all. You can use quantitative techniques, but their understanding of quantitative techniques isn't very relevant. Their understanding of capital markets is highly relevant. So weighing the difference in different situations is the essence of what we have to do. And what I say here, what I'm trying to describe with passion and dispassion is apply a lot of passion if you have experience and you have a set process. If you're very passionate, but your process isn't very robust or defined, or you don't have a lot of experience, you're likely to get bad results. So when you have the guardrails of experience and a process, be very passionate. When you are doing the second step, when you're trying to synthesize everything and come up with a final forecast, that's when dispassion has to come into play. You shouldn't be pounding the table and say, I just feel it in my gut. These guys are great. That may work, and you may be so experienced and so good that your gut is really a robust system. But you have to measure your passion with objectivity, and you need help from others that are experienced, different points of views, etc. So with that, quite a bit of information. We'll go back to questions and start with Jordan. Maybe you could talk a couple of minutes about your process and how you do things.
Sure. Thanks, Mark. It's a little like try to summarize everything you do professionally in a couple of minutes. So I'll try to pick a couple of things to focus on. I think first of all, our process is stemmed from a philosophy around investing that appreciates that investing is hard, and that exceptional investors are rare, and that you have to be incredibly selective. Also have to know what you think works. So Mark addressed this, personal and different approaches. We have a philosophy that I think makes sense to us. So everything we do is based on fundamentals, it's based on a long-term orientation. It's based on the idea that the markets are going to be relatively efficient in most cases, but periodically, episodically, with a lot of research, you can identify select opportunities where the market's giving you a price for something, and your research has uncovered a reason why that price isn't the right price. And you do all the right things in diligencing that, building a portfolio to realize that you can actually outperform versus the market. Our job, therefore, is to look for people who can do that and do that well and do that repeatedly. So one idea is that we meet a lot of people, and we have very high bar. So we have a pretty tailored portfolio of funds, but we're always humble enough to know that A, future performance isn't assured, and B, there may be somebody better out there. And so we're always saying, can we either add to our capabilities or can we constantly upgrade versus what we already have. But it has to fit this idea of sort of fundamental and long-term, because that's what makes sense to us. And we appreciate that there are lots of other approaches. There's vector-driven and quant-driven and all kinds of things. But for us, we need to know how to make the decision around when a manager doesn't do well, what do we do? If we can't explain it, then we can't really invest in it. We have a pretty large team, I think, by Mark's chart, we have both generalists and specialists. We have a lot of experience. But we're very consensus driven, and the belief there is that the group will make better decisions than the individuals will. Certainly some of us have more experience, but again, there's a lot of ground to cover. And so, when we look for concentrated investment portfolios inside of a single strategy, it's the idea that you could only know so many things so well. So we want to be broad in what we look at and then deep in what we own. Generally, our meeting process is about talking through investments. And again, this is because while the history is informed by the track record, the past is informed by things you can evaluate quantitatively, and that should weigh on what you're doing for sure. The future is unknown, and the future is what you're actually investing for. You're always looking forward. Money is at risk today. You're making a decision today, whether it's around a stock or manager, and that's the approach that we try to take. And that requires a blend of sort of rigorous quantitative analytics and then some subjective pieces. So our process is about talking through individual investments and trying to get at what is driving decision making for a manager, what is their process, does it check these elements? So we have our ideas around what is a source of edge for a manager, and actually I sort of charted that over time from when I was picking stocks years ago. And basically, if you just pro forma earnings models, you could probably do better because people weren't that good at sort of basic blocking and tackling. To today, where the ability to get an informational advantage requires sort of the extreme of proprietary data sets and building your own analysis through scraping internet data, because it continues to get more efficient. The frontier continues to move. So when we're talking to a manager, we're going to talk to the portfolio manager, we talk to the analyst. It's about getting into these details. And then the other thing that we're very driven by is the behavior versus the narrative. So we want to hear about what's going on, what decisions you're making, but we also like to track what's actually happening inside of portfolios. I think one of the things we learn a lot from is just watching a manager for a while and what decisions they make. Why did this stock come out of the portfolio? Why was it sized up or down in real time? Because in the past, you can always sort of fit the narrative to what best suits your interests, but in real time, there's a lot to learn there. And then, we go through a long approval process. We write up everything we think that matters in a pretty detailed report. I think we're going to come back to this on behavioral biases, but the idea is let's do our work now, let's underwrite it so that we don't have to react to performance. We're not prone to reacting to performance, because again, that part's unknown. But today, looking forward, we believe we're making a good investment decision. We want our managers to have a lot of runway. We want to be very sticky investors in anything. And unless we have completely botched our underwriting process, no matter what happens right after we make the investment, we're not going to react to the numbers. So that's the short version.
Thanks, Jordan.
Our process essentially starts from understanding who our end client is, which again is retirees, individual retirees. So our whole lens is based on analyzing for that income distribution. That doesn't mean we're looking for yield. It's the opposite. It's all total return based when we're solving for income. But that means we're looking at every fund as far as its downside. So through that lens, obviously it's a huge undertaking with over 10,000 mutual funds or ETFs. Last I looked, 10,064 mutual funds and ETFs. So you have to start the screening process, and we all say, we saw some people yesterday and they're saying, well, it's obviously performance. You have to start at performance, because what else are you going to do? But I think the problem is how are you going to look at performance? Just the recent performance, last 135. So the screening process, I think it's vital to start the screening process by de-emphasizing performance, even though you have to have it there. So 55% of our first screening process is non-performance based. So that's, basic things like fees, making sure the manager tenure is related to the actual performance you're looking at, but then it's scoring also on other metrics about the firm. So it's what's the firm manager turnover rate. It doesn't matter about the fund, but at the firm, because that's at least one way to look at, is there disruption within the firm? Our manager's turning over, then that's an issue. So screening things like manager turnover rates at the firm level. Again, what's the fund success ratio at the firm, risk adjusted success ratio at the firm? Because again, is the firm just picking strategies because they want to gain assets? And if so, then that's probably an indication that they're not that great at things. So these are just small firm-based attributes that you want to score on to de-emphasize, again, just de-emphasize performance. And there's other firm-based levels that make up that 55%. Again, a lot of people look at, does the manager invest in their fund? And yeah, it's important, but we also want to know what percent of managers at that firm invest in their fund, because I think that's a cultural thing as well. Is it throughout the whole firm that people have that attribute to invest in their own fund? And then turnover ratios would be another one, because I think again, anything that gets away from what is the performance, the turnover ratios, again, we think it's very, is this going to increase cost? I think low turnovers. We are again, for retirees, less risky, so low turnover ratios. And then when we get to the 45%, that is going to be performance based, we try and spread it over a million metrics, because there isn't one attribute that is going to determine anything, and everything is set date. I don't care. The last 3 years is not important, more important than the 3 years that was 2 years ago. So every performance metric is rolling basis. It's a 3-year rolling basis for the past 10 years, every 3-year rolling period for the past 10 years. If you don't have that long of a track record, then it just prorates it, weights the other attributes higher. And so that's going to be, use 6 different, risk-adjusted returns, because again, Sharp isn't better than Trading or Calamar. So we throw in all the risk-adjusted metrics. And then it's for retirees, so we're looking at downside capture ratios, max drawdowns. Again, every 3-year period, because maybe they were, they had big drawdown 1 3-year period, but they didn't have big drawdowns in another 3-year period. So again, all those are just thrown in, give you a basic starting point to now, because again, we're a smaller firm. We manage a decent number of assets, but we're on the Forbes top 250 for wealth advisors, but we're team small, 13 people. Literally, 2 of us are handling the whole manager selection process. So we have to get this screened so that we're going to look at, once we get the scoring down, we're going to focus on the top 15% that scored. And then we're going to start doing the deep analysis into the holdings and does the strategy make sense? And that, because we don't have time to do a deep dive on every fund. So once we get that scoring process, we're going to find philosophies that match with our firm. And again, it does have, we don't micromanage those. While we'll look at the holdings, the whole reason we're outsourcing this is because we aren't the experts. So I don't know, I can have an idea, and so when you go in and ask managers questions, I find 3 stocks that I'll get a deep understanding of, so I can ask them the questions about why is this in your portfolio. But again, we're not micromanagers. We're not going to decide, you sold that, we don't agree. We're going to, that's not our job. We're not the experts on this. So again, it's art to a big degree, but essentially it's you just gotta work it out essentially. So
Thanks, Adam.
Yeah,
That was great.
Sure, I echo a lot of things that Adam and Jordan Jordan said, we are looking for robust and repeatable process can deliver good outcome consistently. We are very fortunate. We get great access to managers. A lot of managers come to our office almost every day or every other day to present their strategies. We are happy to take meetings. We are happy to take conference calls. We have a 7-people team on the manager research side, 3 leads, and each is a subject matter expert on equity, fixed income, or multi-assets. Also have analysts under that. So we try to be deep, try to be broad, and try to be really ask smart questions. When we say we have an introductory meeting with the prospect manager, usually we will write a manager research report, and then to rank the manager, we have an internal rating. Does that worthwhile to to do follow-ups, to have additional conversation. And then we had a monthly research meeting. 7 people will discuss pros and cons, and does it potentially fit any platform that we have. And just we support all the business units, including variable annuity, retirement, and life. So some proprietary funds, some are third-party funds, and some have some constraints, some are more unconstrained. So it varies, and then some have bigger flow, some even just getting to know on the platform. I mean, they all have different characteristics. And then we try to be long-term as well, and I don't like to just talk to manager once and then hire them. Like I don't feel comfortable. I like to know the manager for a long time, or know how they perform in different environments, how they react to that, and then eventually. So it's a long-term relationship instead of just one-time handshake and then we just hire you. That's why we really emphasize building a bench. Even we currently say don't have a search going on, but we want to have a backup. What if the existing manager all of a sudden they have some key men leaving or organizational changes, and we need to take action right away? If we have a robust backup list, then that will really make our lives easier. And talking about the search, usually we will have a first, a conference call. We use Morningstar investment, look at all the performance, position characteristics, analytics, anything you can think of performance, information ratio, shock ratio, downside, upside, whatever you can find in the investment. And after that, we ask more qualitative questions. And personally, I think I'm more qualitative than quantitative. Just first, past performance doesn't indicate future performance. That's the first thing. Second, ultimately you're focusing on process, right? Can they continue to deliver? So asking some questions, behavior questions, and how they interact with each other. A lot of things, it's like you kind of read from the conversation instead of just numbers. We internally, we try to be collaborative. So we have the 7-people manager research team. We also have an investment committee. After the research team make a recommendation, you will go to the committee and ultimately go to the mutual fund board. So I would say the process, at least 3 to 6 months. If we launch a search, just internal, we have a different governance there. After we hire a manager, we have this rigorous ongoing manager oversight process. We at least have a quarterly call with each manager, do a deeper dive on their performance review, business update, personnel update, all those, and we are required to go on-site at least once a year for the existing manager.
That's great, thank you. We have about 10 minutes before we're going to take questions, so I think I'll mix up the topics a little bit. Jordan, start with you, and maybe you could just talk about, I think all of us can understand, just to digress for a second, all of us can understand, we could have an entire conference just on behavior bias, which to me, I love thinking about it as just simply the difference between objectivity and subjectivity. I think of objectivity as the truth is there's a truth out there, none of us will ever see it, because we all see it through our own prism. You could think of that as crudely, well, that's our bias. Our subjectivity is our bias. Unfortunately, we're our own agents. So that subjectivity, it says, when you seek support for something, do you seek for support for something you believe? Or are you actually seeking the objective truth? most of us recognize behavioral biases. We don't seek the objective truth, we seek what we want to find. So specifically to you, Jordan, when you try to control for that problem internally within your own process, what do you do to control for your own potential biases and overcome?
Thanks. It's an interesting question. So I mean, I guess there are a number of ways we try to combat it. I mean, one is we acknowledge it, we study it, read books about how people do these things well. So at least it's at our forefront. It's always a valid sort of challenge to bring to somebody. Is this we're making the best decision? But part of it is it's a cultural thing within our team. So we're very we've developed this wonderful culture of being able to challenge each other based on the ideas, so that there's not an ownership of an investment or an ownership of an idea, but it's very the group believes let's get the best out of everything together. If we make a decision, we collectively make the decision. Everybody has to kind of buy in on it. There's no look back option for somebody to say, well, I never agreed with making that investment. And that really focuses everybody on what's the best decision. And it also allows people to say, hey, I think you're buying in on something that's not real. More pragmatically, we do use a lot of numbers and measurements. We also do a very structured process, both around onboarding a manager and then evaluating it going forward. And I think that process is the thing you can anchor to. So if you remove the subjectivity as much as possible on decisions, you're left with less bias. And finally, we do actually something I think is a little bit clever is we survey our own team on our platform in different ways, but simply as what's your highest conviction, U.S. long only, mutual fund strategy on the platform. And we do this every quarter. We meet every quarter to review each of our funds, and what that data will illustrate is like, hey, you have a higher conviction in things that have done well lately. As a team, it just reminds all of us, like, no, we're not immune to these things. And so, we can actually then have it in our face and say, yeah, the guys who've done well have, their scores have trailed up, and at least use that to sort of counteract a little bit our own bias.
So again, I'll try to mix things up here a little bit. One thing that I think FRA recognizes, we have these kind of huge domains, and we try to capture them in 45 minutes or something, and then to try to talk about behavioral bias, for instance, it's just such a huge topic. So I think I'll ask you a question, Maria, one of the things we talked about beforehand, and that is something that we used to talk about at Russell all the time. We used to say, and it was largely true, that we didn't care about the org. It didn't make any difference. Like, I personally thought T. Rowe Price was the best mutual fund house out there when I was doing management research, when I was in the trenches. But there's products at T. Rowe Price that I thought were just god awful. They're terrible. The portfolio manager didn't know what he was doing, they had way too many assets, et cetera, et cetera. But on average, I really like the culture of T. Rowe Price. I like Jim Kennedy, who's the most impressive individual I've ever met in the industry. He ended up running, he was head of equities when I met him in the 90s, and then he ended up running all of T. Rowe Price. But I never endorsed T. Rowe Price as a firm. Your odds are higher if you get T. Rowe Price, but you have great odds of getting a terrible product. So how do you and your organization assess the importance of the brand, the firm, versus the products at the firm? Again, Russell's bias was, we don't care anything about the firm. We did care a little bit. Obviously, I like T. Rowe Price, which would color my selection.
So we have both large brand name managers and also small boutique managers. I view investment merits of the strategy the first and the foremost important. However, because our end investors are retail, right? Variable annuity retail. So our clients do care brand name, reputation does care. I think I heard that comments yesterday that echoes a lot of insurance companies, the same thing. And I would say if it's in the final, there's one small boutique manager, the other one is large brand name manager with strong distribution support. The larger manager certainly has some advantage because right now when we hire manager, of course, investment performance is very important. We also like managers to provide distribution support, sometimes to co-brand product with us, and also provide some thought leadership, and potentially can partner with Lincoln, the parent, like insurance side, for some like strategic initiatives. So it is important. Another thing is, Lincoln is also going through mergers, acquisitions, consolidations on different funds. So the direction is to have fewer managers with larger mandates and a lot of things, the fees, right, relationship pricing, all these things into consideration. So, but I wouldn't downplay, say, boutique manager. I mean, we have those. We take all the meetings. We certainly, like, if they have generated strong investment result.
Sure, that's great, thank you. I think we'll move to like kind of a lightning round Q&A here. And the first question I think is interesting for the audience, and just interested to hear your answers. And maybe Jordan, you can take this first, because I know you like this question. What are some of your pet peeves that you could serve up to the audience when you're dealing with managers that you dislike their approach, either throughout the entire process? What are some of your pet peeves from the other side?
So I have, I guess, one just minor one. I thought you were going to the other question. The one thing we ask is if we ask to talk about an example in the portfolio, pick an investment example or pick something you put in the portfolio recently. Please do not talk about something that you invested in 7 years ago that's up 4x and how that narrative all played out, and that amazingly everything worked out perfectly in that story. We can't learn a ton from that. It's good to know that there have been successful investments. Everybody's had some. So we really like talking about sort of real living live examples today, and where we don't know the outcome, where we're all going to then learn together going forward. We're all humble. We're best investors get 60% of their picks correct. So it's not a matter of whether the one example we talked about worked out. It's more about just understanding the process with a forward-looking lens as opposed to a look back.
So I think I like this question a lot because at Russell it took us a long time to rank manager. So maybe all three of you can answer this question, and it's what is, and this is a lightning question really, what is the quickest you've ever rated a manager when you didn't really know anything about the product, and then you're so enthused you got it done and rated that quickly? So what's the quickest, and then conversely, what's the longest where you knew a manager and you liked them, but it took you 4 years to get them in the stable? And then what's the average for each of your organizations? So what's the quickest you've ever done it? And not why or anything else, just what's the quickest you've ever done it? What took you the longest, so you don't have to explain why, and then what's the average period of time? So when a sub-advisor here in the audience comes to you and says, how quickly could I get this done? What's likely to happen? And what's worst case scenario if they like me? So maybe Jordan, you can start with that.
Sure. So I would say the quickest has probably been 3 or 4 months, and those are fairly exceptional circumstances, like the fund's going to close and we wanted to get in before they soft close. Our goal is to continue to evaluate people, and we already talked about there may not be an immediate need, so really the longest can be indefinite. There may be people we're continuing to talk to today with an idea that hey, circumstances may change, and the average is probably 6-9 months, something like that.
Yeah, I'd say quickest, we generally keep her on the bench for us. So quick, usually they're on the bench, but I'd say maybe the quickest turnaround was 2 months, but that's very unlikely. I mean, I'd say longest, 5 years, and people are still counting, but probably what we've used is 5 years that we've looked at them. Average, probably, it's actually a long time, but people are, I'd say average is probably 2 years.
So I would say the quickest 3 to 6 months. The longest can be years. I mean, it's not like you're not good, you're great, but maybe internally we change priority, right? It's product and different needs. Average, I would say 1 to 2 years.
And a question, because we talked about this just before the session. At Russell, we had what I considered a luxury of the operational due diligence and the compliance due diligence all as one function, and it was completely separate from the forecast of future excess return, because we wanted to have kind of a purist view of what's the power of the process in that forecast of excess return, and then let a whole other group look at all of the things that might limit our ability to work with them because there's some compliance shortfalls or something like that. So, well, actually, all three of you guys can answer this. So you mentioned that ODD was separate at your firm, right? So Adam, is it separate at your firm, or do you have responsibility for ODD as well, operational due diligence?
Yes.
Okay. And then, Jordan, your firm, is it separate or?
We have a 3-person ODD team that has independence, but we all do research meetings together, our investment committee discussions, so they understand the issues before we've even made a decision. So our team meets every Wednesday morning and spend 90 minutes reviewing all of the funds we've met with and all of our thoughts. That's important for ODD to understand, to know kind of where we're headed. Oh, it's time to start getting ready to go look at this fund. But then I think, there's obviously clear, binary decisions. This is good, this is bad. There are sometimes decisions where it's like, hey, this is maybe okay for a non-discretionary mandate as long as we can articulate what the issues are for a very sophisticated family office client. And so it's good for them to see the sort of full range of issues. And we are collaborative, but they have full ability to shoot down anything we're doing.
Mark,
Okay.
I can add to that.
Sure.
So my team is more investment due diligence. We do have compliance due diligence, but many times we go together. So we sit together for the firm and personnel update, and then we have breakout sessions, compliance do deeper on the compliance topics. Another thing is I'm very well involved on the compliance topics if there are any issues. We all sit in a one board meeting, so I heard their discussion, they heard mine. And sometimes it's actually like the TCA right now is like transaction cost analysis. I don't know if it's just investment topic, it's compliance, or it's operational. I'm very well involved in talking to managers on developing that analysis. So I would say these days, investment also need to understand operational nuances. That's just I'm also on the fair value committee, like responding to fair value emails every day. So.
Okay, we did pretty well. We have 8 minutes left for questions. I don't know if anybody has any questions. I have additional questions that I can ask these guys if anybody doesn't have any questions. It's a broad topic, so we'll take any question that anybody has. And you can direct it to anybody you want. So yeah, please.
For each of you, you said a bench list. Maria, you mentioned having a bench list. How many managers do you typically have across the asset classes for your bench list?
We actually have for each style box at least 5 or 6.
Yeah, we have about 3 to 4. We have three to four we're actively using each category, and we have 3 to 4 on the bench.
We try to have one that we're going to use for every active category, and it's usually a pretty hard process to get to that one. And so we may not have a bench. We may have sort of a, group that we would go to kind of get into if we needed to. But we don't have the bandwidth to kind of constantly update to the level of depth that we do have many bench managers. But we're always trying to traffic in the idea. So I don't know that we have a specific number, but we'll probably have a guess at like the next 2 or 3 people we need to talk to.
Any other questions? Okay, I have a couple. Oh,
Just a quick one.
sure.
So with the rise in collectives, especially as in the OCIO side and the pricing flexibility, does that factor into your decisions, or do you just focus on mutual funds, or is it the investment and then you don't worry about the vehicles? How do you guys handle that? Because it seems like the OCIO, 401k are really looking at collectives.
So I can start. So we currently have both third-party funds and also our own funds, right? But we're thinking more like business side. So we have bring a lot of third-party funds to internal funds just to increase profitability, but still higher than the supervisor. You see what I mean? So we retain the investment excellency, but also improve the economics.
I'd say something on that. We only use mutual funds and ETFs, and I guess this goes to kind of a pet peeve sort of question about me and the whole product development side. And this is, we like broad mandates, and I think a big lack in the industry is giving your strategy in a global format. I mean, I don't see what the issue is. People say it's the money's not flowing there, but I want global mandates, and it's ridiculous how few global mandates there are. I mean, there's 10,063 funds, 4,400 equity-based funds, and 1,100 some of them are small and mid cap US only funds. And there are literally only 49 global small mid strategies on the ETF and mutual fund side. What's going on here? I talked to some of the managers here, and they're saying we would love to offer our strategy, but the money's not flowing there. I don't see why it's not, especially if you look at the ETF side too. I mean, talk about tax efficiency. I shouldn't have to buy 3 different ETFs to make a global strategy. It should be rebalancing within itself. So that's the most tax efficient way to give a strategy. So obviously I have a little pet peeve there to get off my chest, but no, I want global strategies.
What's interesting though is it's really a huge opportunity. Russell actually has a pretty compelling global small cap fund, which has got a bunch of managers, both globally oriented ones and these local boutiques. It's a great proposition from them, but it hasn't done as well as you would expect it to, but it kind of solves the problem you're just talking about. So yeah, it's kind of weird to me as well that there's this sweet spot. Everybody knows that the small cap in the US, there's tons of small cap US managers, a ridiculous number of small cap US managers, but there's many of these global, which is surprising.
Mark, I can shed a little light on that.
Sure.
So the reason why, at least I can speak for my firm, is that they don't play well with models. And almost, a lot of stuff is driven at a model level, and they want to be able to, put in their own thought leadership. How much goes into domestic, how much goes into international. You essentially take those keys away from that car with your issues and global strategies. I don't disagree with one thing you're saying at all. I 100% agree with you actually, but that's the reality of it. You don't see a lot of global mandates because it lessens the chief investment officer's ability to actually express their thought leadership.
That's a huge point. I can think about it, but that's a huge point, and it's not just for that space, the global small cap, it's for the whole
Balanced
thing.
strategies too.
Yes. GTAA, TAA, that's a good point. Any other questions at all? We have a couple of minutes.
Do any of the panels cover private equity or private debt? And if so, is your approach different for those types of asset classes versus public equity, public debt?
Yeah, we are mostly public. On our general account side, you have alternative. That's our my scope.
We do, I mean, I think obviously there's tremendous nuances and differences around, structure. To the previous question, we'll invest in any structure that works for a client. So it could be usage for an international client or a partnership for, drawdown vehicle. But obviously if you're in something that's less liquid, both in terms of the underlying assets you're investing in, or the structure, you have, you have greater questions around, organization and so forth that, have to be understood, because you can't reverse those decisions. But the fundamental approach is how do you add value is the same. It may be sourcing, though, in this case, which is rarely an issue in public markets. It may be adding value through board engagement, which again may be a subset of public markets, but there's a lot more drivers of return on private assets.
So one thing I'd say about Russell, what we try to do is say, okay, what are common to every investment out there? And like one thing that's common is there's a measure of overvaluation and undervaluation. Doesn't matter if it's private, public, anything else. And then we'd say, okay, well, just to be simple, what are the things that matter for equity that are different from what matters for fixed? So here's what matters for everything, and then what matters for equity, what matters for fixed, and then what matters for private and what matters for public. And we try to capture this, and they did have a different approach if there was specialists, especially. And so like for private, the big thing is liquidity. You don't get a price. So it's inherently different when you're trying to evaluate these private things, because you don't have the market telling you what they think. This mark-to-market thing, it's not accurate in general terms. So the people at Russell that did private stuff, they did things differently than the people that did public stuff. And the big piece of it was this lack of pricing visibility on what was going on. Sure.
Just to parlay off that, what about, just the alternative space in general, since obviously the rise after the financial crisis with, daily liquidity, alternative strategies, liquid alts, call it what you will. Is that an area that you guys are, incorporating into your research?
Yeah, we do use some liquid alts a little bit, but we're more plain vanilla generally. Long, short, those sorts of, maybe managed futures, but yeah, we use liquid alts, and go back to the kind of private side, we don't really use non-traded stuff, and one, I don't believe in illiquidity premium, except as it applies to like, bonds, less traded bonds, and that sort of thing. But as far as the asset classes, I don't believe in, like, for instance, REITs, publicly traded REITs outperform over any period longer than 5 years. Why? After 5 years, because they don't full cycle before then. So they look like they're outperforming just because once they full cycle, then they underperform. So I don't believe in the liquidity premium, so that's the primary reason we don't use non-traded bonds.
Okay, that's it, Sunita. Now it's your session for quantitative.
So as Sunita gathers her panel, let me just introduce you to Sunita Advani, Director of National Accounts for